Welcome to the Broken Pie Chart Podcast, episode 247. I'm your host, Derek Moore. Back with me is my semi-permanent co-host, CEO of ZEGA Financial, Jay Pestrichelli. Jay, how are we doing today?
Derek, doing well. Glad to be back. I think you let me off for a week.
I did. We had actually an in-depth episode really asking the question, are investors rooting for the wrong thing? And it was, everyone wants lower rates, but if the Fed has to lower rates, doesn't that express that there's some sort of pain in the economy somewhere? I don't know. We'll talk a little bit about what Goldman Sachs says about rates going forward today.
Yeah, I got some rate commentary. Like, it's a brand new topic for us. Kidding. Let's roll, buddy. Let's roll.
Well, you watched something on, I think Ray Dalio had some comments. Ray Dalio's a little bit under fire, too.
He is. I mean, do you want me to comment on that for a minute? What he said this morning?
Let's talk about that.
He was asked, his outlook on rates, and I thought he did a really good job of succinctly explaining the primary driver of rates. The very first point that he brought up was inflation. He said the Fed wants inflation and interest rates to be about the same, right? He believes that the 10 years should be paying you at least what the inflation rate is. And then creditors are going to want a little more, maybe another 1.5 points for taking the risk of being a lender. So expect treasuries to be somewhere, the 10-year to be somewhere around inflation plus 1.50, which makes sense. So if the Fed can, get rates, I say the Fed, like they're actually contributing. If inflation can't get down to 2%, expect a 3.5% on the treasury, right? That's kind of what he was saying. Just tie inflation and interest rates together. They should be linked. And the other thing he talked about was then there's supply and demand, right? You got the pull and push, right? You have, in order to, I think he was leaning towards, we're probably going to create too much supply for treasuries, but supply and demand are also a factor. And so if there's too many bonds out there won't be enough buyers. So bonds will drop in price. This is general basic stuff, right? Which means rates go up. So you can have a dynamic of having too much debt out there, which would also push rates a little higher. So those are the 2 points that he brought up on how to kind of get an expectation of what interest rates should look like based on today's environment. So I thought that was a nice, succinct way of taking those 2 points and putting it together. So, whether you believe it or not, I don't know, but that was his perspective, and I shared that with the team today. Derek, you had a comment or two about it, right?
Well, I mean, really what he's talking about there is the return of a sustained period of real rates, getting a real yield, which simply means your real interest rate is what you get after inflation. So like in your example, if inflation's 3% and the 10-year is 3%, like you're not getting a real yield above inflation. So, and we know that really for a decade, more than a decade, since 2008, investors investing in bonds were getting a negative real yield, especially on the short end. On the supply and demand, I mean, what he kind of thinks is it's going to start to feed on itself. Like debt begets more debt, meaning the more debt you have, especially if rates are higher, the more the net interest payments need to be, the more money the government has to finance or issue in bonds. So, I mean, this is one of the reasons, Jay, why I know I'm probably like the only one. There's other people besides me, but I look at things like the bid to cover in treasury auctions. I want to see, like, is there demand in those auctions? So I hear what he's saying, though. I mean, at some point you think, is demand so elastic that it will just keep going and going and going? I don't know. But I do think the return to real rates sort of is something that people aren't really factoring in, where, yes, inflation might go back to 2% or 3%, but what about the time premium? What about real yield demanded by investors, Jay?
Yep. Anyway, I thought that was all good stuff. So thanks for letting me review it.
Yep. Well, I mean, speaking of rates, Goldman Sachs came out with a couple forecasts. And what they did was they said, well, first of all, the probability of recessions. Goldman Sachs among, the Bloomberg consensus is probably a little bit less than 50%. I'd call, I'm just eyeballing this chart, about 57% probability of a recession in the next 12 months. Goldman Sachs is under 20% now. Who's right? Who's wrong? I don't know. I mean, we're talking about probabilities. It's not certainty. But Goldman is kind of saying, hey, we think it's less than 20% on disinflation progress. I don't know about this. I feel like the contrarian would say just when everyone's lowering it is when something will happen. But I don't know if you have any thoughts on this.
Well, yeah, it doesn't look like consensus is coming down really materially yet. I mean, it's, yes, it's kind of like slowly dipping here. While Goldman Sachs is definitely down. What were they in June? They were what, just shy of 40% chance, and now they're just shy of 20. So, yeah, I mean, I think that's an interesting point, right? As soon as everybody feels like the water is clear, that's when Jaws 2 gets released. So I think you and I usually are contrarians, and we feel when everybody's thinking something, you should go the other way. But when I think of the things that would drive a recession, it's we might be a little stressed to put our fingers on it without some extemporaneous event, right? I mean, it seems like interest rates coming down, earnings are going up, bond rates are coming down a little bit. I mean, the market doesn't really feel like it's expecting it. I mean, a lot of things can cause a recession. Don't get me wrong, right? I'm certainly not whistling past the graveyard on this one, but I'm not sure. I think you and I have thought we didn't have to have a recession. Are you saying now you're on the side of, okay, now everybody's in my camp, I got to switch camps? Are you like Groucho Marx, any club that would have me, I don't want to be a part of, kind of a deal?
I mean, I also think that I'm sort of tired talking about this, to be honest with you, because we've been talking about this for the last 2 years or 18 months. And if you go back, Jay, you remember this. Remember in, I don't know, like 2013, 2012, 2010. Oh, we're going to have a double dip recession. The big one's coming, I mean, it's like, this is hard to do, to really predict recessions. And by the way, even if we have a recession, the NBER won't tell us we're in a recession for another 6 to 12 months anyway. So I don't know. I mean, I feel like employment is the thing. It's the last to go. It's really hard to, you don't know that employment's going bad until it's going bad. I know everyone thinks they're looking at an uptick in a moving average or this or that, but I don't know. It's maybe the expectations, though, Jay, that it's coming down lead people to go out and buy more. Maybe that's a indirect impact to that. I don't know.
Yeah, I don't know either. I mean, all those indicators that we've seen that tell us every time there's been a recession, this one thing has happened, right? Like the 3 month and the 10 year, right? Or what was that fun little rule that the woman had that said, well, when this happens with the unemployment rate, I think you're just referencing it.
Oh, the song
Every
rule.
time you move a
Yeah,
recession.
yeah,
Yeah. Oh, that's right. Yes, it's a rule. It has to be true.
yep.
I don't know, man. There is nothing that's absolute in the market, right? So you and I do not operate in absolutes. So yeah, I'm with you. Like, I think I'm getting tired of talking about the recession chance. I do think it matters to the market on how much money people are able to spend, and the consumer continues to be strong. And those are things that really kind of drive earnings and rates, and that's the thing that drives the market. So I'm not sure how much it's really going to matter.
I don't want to spend too much more time on this, but in their forecast, uh, Jay, I sent you a chart. Obviously, the audience can't see this, but on the right-hand side, major developing markets. I think the U.S. is that blue line. If I'm reading this right, Goldman Sachs has the policy rate forecast pretty much not changing in 24 and then start in 25 to go down. But even through 27, if I'm reading this right, it's about 3.5 is where they see rates coming down, which, I mean, if this is what happens, it's a higher for longer, but these change so often. I mean, it's like, if if you're sort of making decisions based upon the forecast you read that week, good luck.
Yep. Good luck.
All right, I want to talk about, you know what, let me talk about auctions. We need to talk about F1, Formula One, and how that can inform us about options markets. That's coming up. I did want to just, I'd taken a screenshot of Treasury auction results. And I'm not going to go through all this, Jay. I'll save that for one that you take the week off. But I do look at these, and basically the reason I bring this up, it goes to your point on the Dalio comments about supply and demand. The Treasury auctions off different. They auction off bills, notes, and bonds, and it's all Treasury. It just depends on when they mature. Things like bills, a lot of times are zero coupon. They don't pay a coupon. They just issue them at a discount. But I just thought it would be interesting to understand, like when you watch CNBC, not you, but the proverbial, our audience watches CNBC, and they say, oh, it wasn't a good auction, or the bid to cover was like, what are they talking about? Well, I pulled up a recent one that didn't go so well. This is a 20-year bond auction. And the final price was 89.35. That gives you a yield of about 5.25%. So think about that. The Treasury is issuing a brand new 20-year bond, and the yield that everybody got who bid was above the interest coupon rate. That means it was, people weren't willing to pay par. They required a discount. But the interesting thing about this, I'm sure you know this, but the audience may not. It's a Dutch auction. So imagine me and you and JP Morgan and Goldman Sachs. And yeah, I'm putting our names in there with those folks.
We're in there. Yeah,
of
you
course.
got it.
So imagine you can put a non-competitive bid in, which means, hey, just give me whatever the final deal is. Or you can set okay, the least, I need to get a 5% yield, right? But it's a Dutch auction. And what's really interesting is, let's say everybody's bidding, and it's the last bid that gets you to sell the whole amount is the highest one. Everyone gets that high yield,
right?
Which is kind of fascinating.
Right. Yeah.
But the bid to cover thing, last thing I'll talk about this, is you look at the amount that's bid or tendered. And this auction was about $33.6 billion. Accepted was $13 billion. If you do the math there, it's about a 2.54, 2.59, 2.6, what's called bid to cover. And that's just a fancy way for saying how much was bid, the 33.6 divided by the 13, and that's your bid to cover. This goes to now I'm bringing it back to the Dalio points. Like if you were worried about supply and demand, you'd start to watch these auctions. And if the bid to cover, meaning the amount that's bid, starts to drop down relative to where it's been, that would show you that the demand is waning on here. So I won't go through all this stuff, but it's interesting to me. Maybe it's only interesting to me, but this is where you would see it.
No, nobody really knows how, and a lot of people don't know how an auction works. So I think it's great that you're going through that. I'll be honest with you. I always thought like whatever they, tendered is what got bought, and they just sold as much as they can, no matter how low that it went. Are you saying that when they tendered 33, billion and only 13 was accepted?
That's right. That was the size. So that's
all that's all that they were able to sell.
Yep, they or wanted to sell. Yeah, I mean they sold that. Yeah, and basically, so what happens though is there's non-competitive, non-competitive.
The tender is not what they were. The tender is the bids that were in there already. What they sold was the 13, not the other way around. They didn't say, "Hey, we've got 33 to sell," and only 13 got picked up. They came in.
No, the opposite. It's 13 to sell, but
it is.
Yeah. So 13 was available for sale. 33 got bid, but people. So let's say someone's like, "Oh, I want 6%." Well, they didn't get filled. They didn't get any, because what they do is they take the lowest yield first, and then they sort of work up until they fill the whole thing. So, but if you're lucky enough, in this case, it looks like about 79% was allotted at the high yield, which is 5.245. So actually a lot of people. But you see in the 20 years isn't as much of a bid auction. But if you look at the 30 year, I think I looked at one recently, 17% of the people or 17% were allotted at the high bid, but everyone gets that. It's a Dutch auction. So it's kind of interesting. All right. I think we can move on from this. I don't want to bore our audience, but but all right. So let me talk about F1, Jay. I know you're excited about the race in Las Vegas this weekend, right?
Yeah,
Maybe not
Vegas,
really.
baby.
All
Yeah.
right.
I wish they wouldn't do it at midnight though. Like they're doing it at really cockamamie times, but I get why.
Well, yeah. I mean, it's honestly. I mean, you're several hours behind me or in front of me, whatever it is, on the East Coast, and I still might tape it and watch it the next day because. So, but the reason I bring this up, and about a year ago, if you wanted a hotel room, somebody gave the example: the Flamingo Hotel, which is right on the Strip, was about $800 to $900 a night, and now I think Saturday night is like $200. And somebody posted they got a room for $18. Tickets are also plummeting. So tickets were supposed to be, I think, $1,600 just to get in, and now I think people are getting in. The get-in price is under $1,000. The reason I bring this up is this so reminds me of an option market. And you think about, you have the dealer side. Those are people maybe who bought tickets and hoping to sell them for more. And you also have the consumer side, and you look at supply and demand. But Jay, doesn't this remind you of option markets where you have time decay, but you also have volatility? And clearly volatility is dropping, meaning the prices are coming down. And also time decay is really high right now, because if you own tickets and you want to sell them, or if you own a hotel and you want to fill the rooms, there's going to be increasing pressure to lower the rates to get people in there. I just thought it was an interesting comparison to the options market, Jay.
No, I can appreciate what you're doing there, right? Because as you get closer, like the ticket after the event is obviously worthless, right? So you have this expiration going on. I'm thinking of the time, Derek, you and I went to a Giants Super Bowl, right?
That's right.
And
In Arizona.
And we didn't go together, but you're like, yeah, I'll go. If I was Jay, if you're going, I'll go. We picked up a ticket, and it's like, okay, I hope this thing works. And it did, by the way, for both of us.
Mm-hmm.
But and that's always that anxiety, right? Like, oh boy, is it going to get through the little scanner? But like, right, I mean, you could charge, you may be able to charge more leading up because there might be excitement or volatility or speculation of a great game. It seems like the speculation of a great race or the public interest is coming down, so no one's willing to pay as much of a premium on it. I think that was a nice try to kind of connect the dots there. That's good. I always like when we can take a everyday, scenario that everybody kind of understands and apply options to it. That makes sense.
I will tell you, Jay, I think we talked about this. I went to the first home game of the World Series, the Diamondbacks, and I did not have a ticket. And that's the benefit when you live in the city and you're sort of indifferent. Like if I went down to the stadium and I didn't get the price I wanted, I would just drive back home. And really, it's my opportunity cost and just the gas I spent to go down there, my time. And lo and behold, tickets were really, really expensive. Waited. And closer you get to expiration, they come down. I got in really at a nice price, and it's.
Did you get the first inning, or did you have a few innings pass before?
No, I got in. I think I got a ticket from somebody who wasn't supposed to sell a ticket, because at some point, like one of the part owners, he had an owner's badge, came up and shook everybody's hands next to me, and then he shook my hand and he assumed I was with him. So I don't know what was going on there, but a little opportunity there. So
somebody shook your hand. Got it. That sounds fun.
I don't know why I brought that
trading,
up.
right? You wait for your price. How many times have we missed a trade by 2 or 3 cents because you waited, right? So sometimes it works, sometimes it doesn't. Do you feel you could have got it cheaper if you waited just another 15 minutes?
Well, to your point, sometimes you wait and you don't get anything. So there's a sweet spot where you take what you get, you're happy with it, and then you just move on. But
Yeah. Yeah.
that's it. All right, Jay. Another thing I wanted to bring up is, will Uber wind up in the S&P 500? I was thinking the other day, and it's really not a question. I mean, Uber is about $120 million or $20 billion market cap company. But it got me thinking the other day about, and I sent you a spreadsheet on this from S&P, the idea that, no one ever thinks about the impact of companies coming in and going out of the index. And, if you look, the last, Hubble, HUBB, they came in on October 18th. Organon, I'm not familiar with that company, they left. But there were a couple big names like Blackstone came in. And, for comparison, I think they replaced Lincoln National Corp, which was a regional bank. Blackstone's earnings and revenues are, dwarf Lincoln National. Airbnb came in and took over a company that market cap probably went too far under. Palo Alto took over for Dish. So the reason I bring this up is I don't think anybody ever really talks about this, and no one ever really, S&P 500 is a living, breathing thing, and companies are coming in there, they're going out of it, the weightings change. We talked about that before. But I think the reason why I bring it up is it's an undervalued thing that happens. Like when you bring in theoretically stronger companies, bigger companies, their earnings are better, their earnings growth should be better in theory. So I don't know if you've given any thought to this lately about, when earnings, everyone's like looking at the earnings and they're making expectations for earnings, but are they really taking into account that in 2024 we're going to have some new companies joining? I don't know.
Well, right. I mean, this is the beauty of the index, where the index is acquiring, is including growing firms and removing shrinking firms. And so, if you had a firm that was shrinking in revenue, they were or earnings, they were driving down the earnings of the S&P. All other things being equal, right? So, if you put in a firm now that's growing, just by the mix, I think your point is like, hey, the earnings for the composite, right? These 500, I think it's still 501, right? Stocks that are in the S&P 500 could go up because companies that are on that have this momentum of growth are coming in, and companies that were causing the down move because they were shrinking are going out. I think I would say certainly that is true. You're not wrong about that. I would ask, to what degree, right? I would ask, I get it. BlackRock is huge, or Blackstone is huge. I get it, right? But overall, does it really matter that much to the change in the earnings, right? Like, I'd like to see, all things being equal, like what percentage of earnings was contributed by Airbnb or Lululemon or Hubble, right? Like, let's see, or Palo Alto, let's see what that's really driving, what percentage and what piece of the overall earnings per share those new companies were versus the ones that were leaving. So I think that ends up being, okay, you're right, theoretically, not theoretically, practically, you're absolutely right. But is it a material difference, is my pushback.
Well, and I don't think you're wrong to ask that question. And one of the things they use is what's called the divisor. And this is, it's not public. I think S&P 500 or S&P, the group that manages the index, they have a committee, by the way, that votes on who to bring in, who to bring out, when to do it. They can sort of do it at any time. Remember, Tesla was the big one everyone speculated on for a while. But they have this formula called the divisor. And the divisor right now on the S&P 500 is 8380.85. What does that really mean? Well, you can imagine that when you have an index, let's say one day all the members of the index are what they are. And imagine you add a really big company that's high in price and has a lot of shares. Well, adding that company and taking somebody else would jump the index. And in order to sort of smooth that out so that doesn't happen, you think about it. If you have splits, if you have mergers, if you have buybacks, all those sorts of things, they compute what's called this divisor. So if you multiply the divisor times the price of the S&P 500, that's going to give you about what the market cap is. And it's roughly 36 trillion in market cap. And it's the same thing if you take the divisor times the earnings per share. That's going to give you your total earnings. But Jay, that divisor, to your point about how much it really matters, it does mute some of this. I think it's so it's not like, oh, you took out a company with $1 million in net income and you put somebody with 100 million and the earnings go up. That's true in aggregate, but the divisor sort of smooth things out. Really, what I think though is if you have better companies that are growing and companies that can qualify because they're growing and they're making money, maybe that does on the margin help to boost the chance for higher EPS. But that divisor thing, which people have tried to figure out how they do it, but yeah.
Yeah, I mean, it's I get it, but look, I think it's a good point. Interesting that you brought it up. I'm probably not. It seems like the index that has like the biggest impacts when they change the participants, and for some reason, is it just seems to be more of an anticipated change is the Russell 2000, right? When they do that rebalance, I mean, you actually could see the options market kind of bracing for a change in the Russell because of the participants in the Russell. Good ones leave, right? They move up, right? They move out of small cap, they move to mid cap. Other ones coming down go in. It's like kind of an interesting dynamic. When you look at the S&P, once you're in, there's nowhere else to go. Like you're at the top of the house, right? So they're not like nobody like Apple isn't leaving because it went to a bigger index, right? It doesn't go to a different classification. Whereas when you look at a Russell, it's coming in and coming out. So I think that reconstitution is always a little more. I don't know. Feels like there's always a little more anticipation and planning around that. But versus what the S&P does. I don't know. Have you observed the same thing?
Yeah, no, I think so. And there is some math. It's sort of once a company is announced to be in the S&P, I think a lot of people try and get ahead of it. And I'm sure the options market looks at that too. Once it's in though, I'm not sure that it is a benefit obviously to be in the indexes because you get institutional buying every 401k that but yeah, the Russell though, by the way, it's if you have a weighting change from a small company, like you said, the impact is much greater. And by the way, the Russell, I think I saw something the other day, 40% of the companies aren't profitable in the Russell. And the PE ratio, unlike the S&P, unlike the Dow, unlike the NASDAQ, when the PE ratio is calculated for the Russell, it does not take into account negative earnings. In other words, when you aggregate all the earnings, any negative earnings are swept aside. They only use the positive earnings.
Yeah, they don't offset the positive earnings of the other companies, right?
That's right.
They don't net them out. It's really it's an absolute value. Well, not really. It's just zero. It's a zero contribution.
It is. I don't think they should do it that way, but it's not up to me. So
and it's not up to us. I don't think you're wrong, but it's not up to us.
All right, I want to change gears. I'm going to throw something at you. We've had a lot of questions recently about the intrinsic value of an option versus the extrinsic value of the option. We use these terms like we know them by the back of our hand. But I wonder if we should spend a little time. I mean, this is we'll call this an options class portion of the podcast. But I'm going to throw this to you. I'll have you get it started. But intrinsic versus extrinsic, and I don't know if you have an example.
Sure. Yeah. All right. I'll put on my options geek hat for a moment here and talk about extrinsic and intrinsic. I think about these two parts of an option as such. So extrinsic is a lot of people refer to it as time value. It's not just time value, right? It's volatility that's in there and things like that. But extrinsic is the part that eventually, when an option expires, I'll say shrinks down to zero, right? Time decays down to zero. The only thing that I can guarantee in the markets is that tomorrow comes after today and options will decline in extrinsic value. Eventually they get down to zero. So extrinsic value is that time component. I think we like to call it the juice of an option from time to time. Like how juicy is an option, how much extrinsic value is in there. It's almost like the intangible opportunistic speculation of an option, right? It's almost like it's the emotional representation of where an option, of where the underlying can go. Intrinsic is actually just straight math. What is the difference between your strike price and whatever you're trading? So like, let's say, for example, we've got our favorite stock, XYZ, that's trading at 105, and you have a call that has a strike of 100. The intrinsic value, the in the money amount, is $5, right? There's a value. And why does that have value? Well, look, if I have the right to buy a stock at 100 when it's trading at 105, intrinsically that has $5 of value to me, right? Of course, I would like to pay only $100 for that stock. It's trading at 105. Well, what's that worth to you? Well, it's worth $5. Okay, that's the difference. That's the intrinsic value. That's the amount in the money an option is. The extra on top of that intrinsic value, all the other pricing in it is the extrinsic value. So let's say that option, instead of just being $5 in my scenario that I just gave, $100 strike call on a 105 XYZ stock, let's say that option was going for $7. Well, we already know $5 is in the money. We know that there's an intrinsic value of $5. The extra $2 for the total of $7 is what is known as the extrinsic value. It's the amount that you get on top of it. And as time decays, as Derek was using in his F1 example, eventually, right up until expiration, there's no time value left, right? Why would you pay anything more than the value right at expiration? So if it was $3.59 on a Friday before expiration and you still had that long 100 call against a 105 price on XYZ, why would anybody give you anything more than $5 for that call? They wouldn't, right? So unless there's something really wacky, but we could leave that out. But generally, nobody would give you more than that. Nobody would give you $6 for an option that's only going to be worth $5 in exactly 1 second from now when the bell rings. So that is the difference between intrinsic and extrinsic. The intrinsic is the in the money. The extrinsic is all the juice outside of it.
I think you went at this from the call side. I'll flip it and I'll kind of take it from the put side. Imagine you sold a $100 put and you brought in $7. Okay. You brought in $5 of intrinsic. You brought in $2 of extrinsic, which means if all else equal, and well, I don't even know why I said all else equal, but let's say the stock is at 105 at expiration, you sort of keep the $2. I mean, that's really what you make. But if the stock changes, you could actually make some intrinsic value as well. So
I think in your example, if I could clarify, I think so now we're talking about an in the money put, right? Instead of an in the money call. You're right. I started with that. So in your example, if the stock is trading at 105, the put that's $5 in the money that has the $5 of intrinsic value is actually the 110 put, right? In the example you were giving, right? Because it's an in the money put. So if you could sell that put for $7, that put is in the money because the strike is higher, right? Again, and people don't always think about the difference of what an in the money put means, right? It means you have the right to put it to somebody. You have the right to sell it, right? So if you're an owner of a 110 put, right, and the stock is trading at 105, at least you're going to be able to sell at 110 while it's trading in the market 105. That's the intrinsic value of $5, right? Of course, I'd like to sell at 110. It's trading at 105 in the market. If somebody wants to, I've got the right to sell at 110. That's worth at least $5. So just the opposite side of the call, where you've got the right to buy at 100 in this scenario, you've got the right to sell at 110. That is the $5 of in the money. Sorry, I jumped in there, Derek, just to clarify the in the money is the difference.
No, it's good. If we actually edited the show, we would edit it out and restart it. Because yeah, I was thinking selling in the money call, and then I switched to in the money put. So thanks for correcting that. Listen to what Jay said there.
I
Not
tried
what
to
I said.
smooth it out. I tried to smooth it through, but that's the beauty of you and I
Yeah,
together.
that's right. That's right. So the other thing I'll point out that is the intrinsic value, like all of the option Greeks, the volatility effect on options prices, time decay, interest rates, all of that stuff. I mean, especially like volatility and time decay, the big ones. That only affects the extrinsic, that out of the money amount. It does not affect the intrinsic. The intrinsic, like you just said, Jay, is what it is. So if you're pricing an option, the in the money amount is always going to be there intrinsically. And then it's all the other stuff, the volatility that affects the extrinsic, so or the out of the money amount. But yeah, I mean, I don't know. I mean, I think the good part about options and a good part about technology these days is people actually have access to this data. On most trading platforms, you can kind of see intrinsic, extrinsic, and stuff like that. But it's still a little tough to sort of conceptualize those two components of it.
Yep. No, I'm glad. Listen, I could talk about this stuff all day, and I think a lot of our listeners like to hear about the things that drive those prices. But it's always, I always like to come back to the way that you might find in a book like The Broken Pie Chart or Buy and Hedge, both of my
Great
books.
books.
Shameless plug.
Yes.
Yeah, great books. Where it always comes down to what is the option. Do you have the rights or are you obligated, and what do you have to do or what can you do, right? And when I say those things, I mean like if you own a call or own a put, you're the one that has all the control. And when you own a call, you have the right to buy the stock. You know where that came from, Derek. Maybe not everybody knows. You have the right to call the stock away from somebody, right? I'm going to call it, in other words, buy it. I guess the term buy was already taken when they were coming up with option terms, right? But a long call, right? When you own a call, you have the right to call the stock away from somebody. And with a put, the same thing is true, but the opposite, right? I should say the opposite is true. You have the right to put it to somebody or sell it to somebody, right? I don't want this stock anymore. Stock's trading at 105. I want to put it to somebody at 110. They got to give me $110, right? So if you can always go back to what is the right and what is the obligation with the option, it helps you kind of always, think through what's most likely to happen, right? We talk about this all the time with options that are in the money, that have intrinsic value. We just talked about that a second ago. But the extrinsic amount actually matters on how the person who's on the other side of the trade may react. Let's take, for example, you've got a deep in the money call, meaning the market, you're the one that sold the call, right? The market has kind of moved up. It's through your call, right? Let's say the market is trading at 105 and you sold that 105 call, meaning somebody has the right to give it to you, right? They could call it from you at 100 while it's trading at 105. So look, even me explaining it can get a little jumbled. So if you are the short call holder, let's say Derek, you are the long call holder, right? You're long the 100, I'm short the 100, and it's trading at 105, right? You're psyched, right? You're like, hey, I got the right to buy this stock at 100, even though it's trading at 105. That means I have to, I'm going to, you're going to call it from me. I'm going to give it to you, but I'm only going to get $100 for it as the short call seller, right? So that's the dynamic when it comes to the options. But what matters at expiration, obviously, you would say, look, I want the stock at 100. It's trading at 105, right? You would obviously call it from me, and I would have to give it to you, and I'd only get $100, and you would own now the stock at 105. At 100 while it was trading at 105. But what about if that option has this extrinsic value in it of $2 extra? Now it's $7, right? So let's say we're coming up on expiration and you're like, well, the stock could still move quite a bit, right? It's trading at 105. I don't know. It could be down at 100 in 2 weeks from now. I don't know if I want to take the stock right now. I could call it, right? You could call it at that price, Or you could just trade the option in the market, right? You've got all this intrinsic value. It's in the price, right? The option price is always going to carry that $5 gain, but then it's got this $2 juice on top of it, right? Would you, in that scenario, if you're ready to get out, would you exercise your call and make me give you the stock at 100, or would you just sell that call for $7 out in the market?
Well, I think it's obvious. I'm going to take the $2 extra.
Right. You would then trade the option. You'd say, well, I don't actually want to spend all that money, right? Now I got to look, it's a $5 gain. If I buy it at 100 and turn around and sell it in the market for $5, that's your intrinsic gain. That's right. Or you could just sell the call. Like, hey, I'm just going to trade the option away, right? I'm just going to trade it for $7. So in other words, when you are short a call, and this is a lot of times that people forget this, right? You're short a call or short a put, and like if you're running a covered call strategy, and the market is run up through your strike, you don't have to automatically expect that you are going to have to deliver the stock, meaning it being called away from you, at the strike price. Sometimes there's enough juice in the option where the person on the other side of your trade, and there is a person on the other side of that trade, right? You're not trading against the big blue nether of the options world. There's someone on the other side that says, you know what? If I want out, now's the time for me to close that call out, and they'll make $7 instead of $5. And so it's just one of those things that I think people always worry, like, well, as soon as it went in the money, buy stock, buy XYZ. Not necessarily. If there's still enough time value in that option, you are not going to get assigned. Look, you always have the chance of getting assigned. By the way, you always have the chance of getting assigned even when your option is out of the money. There are plenty of people that make mistakes with options, right? And they accidentally do something like that. So I'm not saying you don't have the chance, but any rational trader on the other side of your trade, why would they only make $5, right? Instead, they could make $7. By the way, you as the short, I guess you, I say, as anybody that's holding the short call, you just got out of owing $7, right? When you have that short call in your portfolio, you're short $7. Like you owe $7 if you want to cover. If you want out, it would cost you $7. So they did you a favor by actually assigning the option. So I don't know. Sorry, I went on the tangent of in the money and time value and assignments, but I think a lot of people that sell calls feel like selling calls is really easy until all of a sudden your calls are in the money because the stock has moved up through them. That's okay. Calm down. You don't have to act right away. Watch that extrinsic value to determine if you're going to get assigned or not.
I won't go through the mechanics of how, a random assignment, meaning not on expiration day, but early assignment, if somebody chooses to exercise and get shares, there's sort of a randomness about which firm, which accounts. I will tell you, though, Marty Kearney from the Chicago Board of Options Exchange, him and I used to do these joint presentations. And with a very straight face, he was, somebody asked a question, how is it determined? He says, well, basically, we go out at the end of the day, and we have a big wheel, and everyone's account numbers are on a piece of paper right on LaSalle Avenue, and we make a big deal about it. We have a band, and we spin the wheel, and we pick account numbers out of it. And people were like writing down, like they thought he was actually being serious. He's like, no, that's not how it's done. There is sort of a random process, but it's been a long time since I've explained it, and I think we've done enough detailed
I've worn
explanations.
my nerdy options hat long enough. Okay.
It doesn't matter.
Enough.
It doesn't matter. All right, Jay, let's get to some things. Do we have any recommendations? I actually have a few, but I'm going to go to you
start
first.
Out. No. Okay. I'm going to let you start. You start.
Yeah. Well, I'll go. I'll give one, and then I'll give another one after yours. So the first one is a book called The Fund by Rob Copeland, and we were talking about Ray Dalio earlier. It's on Bridgewater. It's on Ray Dalio. I think it's pretty interesting. I'm not too far into it. It's not painting Ray Dalio in the best light, both from sort of an organizational standpoint, and then also just return and market calls and things like that. So, but I think it's a really good read so far, and so that's one of my recommendations. The Fun by Rob Copeland. I think it's brand new. It's only been out like a week.
Oh, all right. I have a recommendation for something that you should not see, which was disappointing.
Oh, you have a sell
So
recommendation
I have a sell, not a
and
recommend.
avoid.
Yeah, not a
Okay.
buy. I got a sell. It was produced by and directed by an actor that I really like, Charlie Day, who is from Sunny in Philadelphia, if you know him. He had a movie that came out called Fool's Paradise, and it had a lot of big names in it, right? And I was like, Ray Liotta was in it, John Malkovich was in it, Edie Falco was in it, Jason Sudeikis was in it, Kate Beckinsale was in it. I was like, wow, there's a lot of great names in this, and nope, don't do it. Don't watch it. I would say not really. I get what he was going for. Not my favorite. Yeah, even Jason Bateman had a little role in it. Common had a little role in it. Adrian Brody was in it. Like, you think of all these names, and it was not my fave.
All right. Well, that's good. I wasn't even aware of it, but now I know. I will.
But like,
It's
you're
a
a
stay
Charlie
away.
Day fan. Like, I love everything Charlie does, right? So I try to watch everything. I was, disappointed in this one. Sorry, Charlie.
Horrible Bosses was a couple of his
Hilarious.
movies.
Yes.
All right,
hilarious.
that's an avoid. We don't get those that often. It's like
No, sorry.
so the other thing is it's a documentary series on Hulu called Brawn. It's F1 in Vegas week, so figured I'd go with this. Keanu Reeves, I think he either produced it, but he does all the interviews. He's on camera, and I don't ever really see Keanu Reeves do anything except movies. So it was interesting to see him. Braun is a team that back in, I think, 2008, during the financial crisis, Honda pulled out of F1, and Braun was the guy's name who wound up owning it he paid $1 or £1, as he says, to buy the team, because he basically took over the operations. And they surprisingly started off, like they won their first ever race as a team, which is unheard of. So kind of interesting. I'm not done with it so far, but that's a buy recommendation, Jay, not a sell. I would recommend that.
I only came with sells today, Derek.
All right. Do you remember when I was first starting out in the business? So I was at Smith Barney, and back in early 90s, there were only buy recommendations. So it was like a buy was a buy. There was strong buy, there was buy, and there was hold. And like strong buy was buy was a hold, and hold really equaled sell. Like no one ever put a sell recommendation. I may have told this story before, and I asked one of the senior people, I was pretty young, how come we never see a sell recommendation? He said, you know what, Derek? If I put a sell recommendation on stock, when they open up their new plant in Maui, I don't get an invite as an analyst. So he said, yeah, it's just hold is really a sell. Nowadays, I think it's different. They actually put the real recommendations on. But you remember, Jay, in the 90s, there was never any sells.
Yeah, no sells. And look, the only time you would is if you knew it was like, hey, this thing's trash, right? You knew if you were still in it by that time, you might be the last person.
Do you remember the Penguins on CNBC when it was Mark?
Oh, yes.
Joe Kernan. It was the three of them for years. Yeah.
That's when Kramer was still on, right? In the morning.
No, this is pre-Kramer. I think Kramer's still
pre-Kramer. Oh, okay.
What was Mark's name? Mark, he sadly passed away.
Haynes? Mark Haynes?
Yes, it's Mark Haynes, Joe Kernan, and the guy who's on with Kramer now with the David Faber. So it's the three of them.
Yes. Sorry,
and
Faber, you're right.
They used to make fun of if you had like five or more analyst downgrades, they would play a video of like these penguins walking and falling into the water. And it was always, a stock was at 50, it goes to 1 on like horrible news, and then the analyst downgraded, and they would play the penguins, the penguin video. You remember that?
I do.
All right.
There was some like horn associated, like some noise in there too, right? Some annoying noise the penguins were doing. Yes.
I think so, but it wasn't where they would just walk and they didn't even seem like they knew where they were going. They would just fall right into the water.
Just fall right into the water. Yeah.
I don't know if that's just how penguins dive into the water. If that's what they do, I don't know, Jay.
I don't get a lot of penguins in Florida.
No, you don't. You don't.
No, not allowed.
Alligators. What do the alligators do?
Sure.
They're just
Yeah.
in the water. All right.
Everywhere.
That's it. We're done, Jay. All right, everyone.
We're done.
We'll be back
Thanks,
next
Eric.
week. See you, everyone. Bye.